on Business Incorporated today. South Africa inflation up 5.5%. World Bank forecasts 4.9% growth rate for Kenya in 2022. Southern African countries count losses from travel ban. Hello and welcome to the program. It's Business Incorporated on Channels Television. I'm Ini John Mekwa. Well, we'll start off with market numbers as usual from Africa, where positive sentiments trailed intraday activities. Nigeria's main index was up marginally, 0.04%. Also, South Africa's JSE index rose by over 0.5% at intraday, while the Egypt EGX 30 was the only laggard. It was down 0.03%. And going to East Africa now, Kenya closed Monday's session positive, up 0.21%. Over to the Middle East, where major indexes were mostly in the red at intraday. The Abu Dhabi main index dropped by 0.33%. Also, Dubai's index edged lower by almost 1%. Elsewhere in the region, Saudi Arabia's main index rose by over 0.5%. But on the flip side, the Qatari index recorded a loss. It was down almost 1% at intraday. Now let's go to Europe now, and we start with the coronavirus situation in Germany as cases continue to sink, raising hopes that the fourth wave has been broken. But we have Chelsea joining us from Berlin now to bring us up to date. Chelsea, can we expect that the restriction on businesses will be lifted anytime soon?
Well, this wave of infections does seem to be easing. We have seen infection rates falling pretty steadily throughout the last week. The health agency here in Germany today reported an infection rate of about 350 cases per 100,000 residents. That's down from about 430 a week ago. So it is a pretty big decline. That likely is in part due to the fact that Germany has had in place these restrictions, the so-called lockdown for the unvaccinated for a couple of weeks now. So people who haven't been vaccinated can no longer go to restaurants or bars or to non-essential retail stores. I would say there's going to be a very high bar for the government to actually to get rid of those restrictions. Even though we have seen cases coming down, there are still so many different factors that could really quickly change the situation. For one, the Omicron variant, which is spreading here in Germany, it could lead to much higher infections rates as well. We have the Christmas period coming up where many people likely will be doing a lot more socialization. So a lot of politicians say this is really not the time to be easing up on restrictions. This will be a bit of a blow for a lot of businesses, particularly retailers have been sounding the alarm about how difficult this is making their lives. One study from the Retail Association here in Germany showed that businesses who have implemented this rule where you can only have vaccinated or recovered people in your stores have lost about a third of their business, and this is, of course, the crucial period for many of them. So we likely won't be seeing that change in the near future, and that's going to be a bit of a blow for businesses here.
Yeah, obviously. But meanwhile, European finance ministers are getting ready to meet in Brussels to discuss the escalating energy crisis in the bloc. Can they salvage the situation? Does it look like it?
There's really not a lot that European officials can do in the short term to really solve this energy crisis. Tomorrow, what we can expect for them to do is really focus on how, in the medium and long term, they can prevent another situation like this. So one thing they're going to be talking about is potentially building up a bigger natural gas storage capacity. So one of the big issues that Europe is facing right now is that it doesn't have enough natural gas. There are a lot of different reasons for that. We came into the year with very low stockpiles as well. Russia, our biggest supplier, has been very slow to send natural gas this year for various reasons. But the reality is that natural gas stockpiles are really at their lowest level in over a decade. They're at about 60% full right now. And that really may not be enough to get us through the next several months. So European officials want to talk about whether they could, for example, pool together to create a joint reserve of natural gas, like some countries have done with oil. As well, they're going to be really encouraging countries and potentially mandating that countries look at their supply and see if that's really, if that's secure enough, if they're too dependent on a certain supplier like Russia here, or whether they really have a solid pipeline of natural gas coming to them. I think that is something that could change the outlook in the next couple of years. But in the long term, they're also going to be talking once again about renewables, which they say is really the only way to insulate the European Union against these fossil fuel price increases and shortages that we've seen this year.
All right, Chelsea, thank you so much and enjoy the rest of your day. We move over now to the UK, where Juliana joins us from our London studio. And we're still x-raying the factors that led to the 5.1% inflation. And it seems a whole lot has contributed to this: food, fuel, and even second-hand car prices. Well, Juliana joins us now to give us details. Hello, Juliana. Good afternoon.
Good afternoon, Innie.
So I guess inflation is still the talk of the town there.
Absolutely, it is the talk of the town. Besides the political scandal involving the British government, the Prime Minister is currently in a pretty rowdy Prime Minister's questions in the House of Commons. But back to the inflation, yes, pretty shocking, coming in at a decade high of 5.1%. That is for the month of November, up from 4.2% during the month of October. This is well above the Bank of England threshold, which is just 2%. And even on this show, Innie, we have discussed that 5% inflation figure, but the Bank of England deputy governors foresaw that coming in about April. The fact that it's come before the end of the year is a major concern, and it is going to add to increasing pressure for the Monetary Policy Committee when they gather tomorrow. Will they or will they not lift interest rates? They surprised us last month because before we discovered this new variant, the odds-on bet was that, yes, it is time to kind of curb inflation. The economy appears to be gradually recovering, that there could have been a rise of at least a point of a percentage, but that hasn't been the case. But the fact that 5.1% has come so swiftly may add to the rising call to stop this now and to allow families to have more money in their back pocket in the coming months.
Yeah, and how is the market reacting to all this inflation talks and figures?
Well, not great, of course. The market went straight into red as soon as the Office for National Statistics released that data this morning. The FTSE All-Share is currently down by 0.34%. The FTSE 100, that's also down by 0.34%. And the FTSE 250, the domestic market, slightly recovering at 0.03% lower. In the currencies market, the British pound has picked up on that data, so it's up on the US dollar by 0.34%, up on the euro by 0.12%, and up on the Japanese yen by 0.25%.
All right, thank you so much, Juliana, and enjoy the rest of your day. Thanks. Well, let's go to Wall Street now. In the United States, U.S. stock futures were muted in early morning trading as investors readied for Wednesday's highly anticipated Federal Reserve decision. Dow Jones rose by 40 points. S&P 500 futures also rose. It was by 0.13%. And Nasdaq 100 futures was hovering near the flat line. Well, to give us details of how the market traded yesterday, we have our correspondent in the United States, Maria Bird.
The U.S. stock market continued to fall on Tuesday as the Federal Reserve began its two-day policy meeting, which will indicate whether or not 2022 could see an increase in inflation or if interest rates will increase. But as we could see, the index took a major hit on Tuesday. The S&P 500 fell by 0.7%. The Dow Jones fell slightly by 0.3%, and the NASDAQ fell by 1.1%. This two-day meeting will also give insight into whether or not easy money policies will begin to decrease over the next couple of months. It will also give indication as to whether or not the spike in COVID cases will have an impact on the monetary reserves in the U.S.
Well, thank you so much, Maria. Well, let's go away from the markets now and look at economies. The World Bank has forecast that Kenya's economy will grow at an annual rate of 4.9% in 2022 and 2023. This outlook takes into account that some subsectors have bounced back strongly, while some only partially. The projection is close to the pre-pandemic average growth rate of 5% from 2010 to 2019. The economy contracted 0.3% in 2020, of course, due to the pandemic. Well, to tell us some of the sectors that were considered and further details of this outlook, we have Limo Taboy. He is a financial analyst with Benkelele in Kenya, joining us now from Nairobi to talk to us. Hello, Limo. Good afternoon.
Good afternoon from Nairobi.
Good afternoon. So what are some of the considerations that led to this forecast from your perspective?
So the forecast of just under 5% for 2020 and again, for 2021 comes after 2020 when the economy contracted by 0.3%, as did most economies around the world. So for 2021, there's been a gradual reopening of the country and great improvements. And they're looking at three key sectors. One is industry, which construction was quite resilient, was not affected too much by the pandemic. And there are a lot of projects ongoing around the country. Cement consumption is up. And that's been one key sector. The other key sector is the services sector, which accounts for 53% of Kenya's GDP. And Kenya is known for a lot of tourist visitors and was getting about 100,000 visitors a month before COVID. And then when the pandemic brought out, you had tourist numbers go down to, it was even less than 1,000 in April last year. With the reopening of the country later in 2020 and 2021, tourist numbers have started to go up. And I think they're now about 78,000 a month. So there's quite some optimism that tourism, along with other service sectors like education, the education sector was shut down for most of 2020 and has reopened in 2021. And then private sector consumption, which contracted in 2020 and is now back in 2021, going up 5.2% this year. So these are what push the services sector. And the third one is the agriculture sector, which has remained quite resilient thanks to exports. Even though there's a bit of drought in the country, in different parts of the country now, you have quite some resilience from the tea sector and the horticulture sector, which continue to be key export and forex earning sectors for the country. Thank you.
So those are very promising sectors: agriculture, education, and all that. So obviously these are the promising sectors. But the outbreak of Omicron, has that been taken into consideration here?
So there's a large vaccination campaign ongoing in the country. About a month ago, on a national holiday, the president lifted a curfew which had been there for about a year. So used to be from overnight curfew from 10 p.m. to 4 a.m. So the government authorities are confident that with the ongoing vaccination program, which I think they hope to vaccinate reach a target of 10 million people by the end of this year. And I think they're at about 7 million now. And then continuing to push masking mandates and a bit of social distancing. I think they're confident that the economy can remain open and continue to grow. So Omicron came up about the last 2 weeks. I think there was a first case reported in Kenya today, but I think the government believes that with the previous measures it has put in place, it should be able to pass this wave.
And I suppose from your perspective, the same sectors that led to these forecasts are the most promising sectors for the economy in 2022-2023.
Yes, so again, 2023, they're expected to continue. The World Bank was really key to work with the government to have more job creation, more formal job creation going forward, and better quality jobs. And I think that's going to be the focus. And with that, it will drive economic growth in 2022 and 2023. There's an election slated for about 8 months from now in August 2022. But most of the banking sector is confident that going by previous elections, it should not be too much of a disruption to the economy.
All right. Thank you so much, Mr. Limo Taboi, financial analyst with Benkelele, Kenya. Thank you so much and enjoy the rest of your day. We'll take a break now. When we come back, we'll have more stories for you from the African continent. This stay with us is Business Incorporated on Channel 7. Welcome back. You're still watching Business Incorporated on Channels Television. Now let's go to South Africa, where the country's annual consumer inflation accelerated to its highest reading in more than 4 years in November 2021, driven mostly by rising transport costs. The annual change in the consumer price index was 5.5%, and it went from 5% in October and September. This is the biggest annual increase since March 2017, when the rate was 6.1%. The transport category continues to be the major factor behind inflation, recording an annual increase of 15% in November. This makes it the only major group in the inflation basket with an annual rate above 6% upper limit of the South African Reserve Bank's monetary policy target range.
The fact of the matter is we've certainly lost the Christmas period. And that's massively devastating. In the first 2 days after the announcement was made, we had cancellations to the value of 940 million rand wiped out.
Yeah, we do have to listen to that again, but that is going to be talking about the United Kingdom, which has announced the scrapping of the red list to allow arrivals from all 11 countries, mostly from Africa. The tourism sector in the southern African countries are still counting their losses. The tourism and hospitality sectors in Botswana, Namibia, Zambia, and Zimbabwe recorded an average loss of over $1,000 per business in the first week after the new Omicron COVID-19 variant was identified, and that's according to a survey conducted by Africa's Eden Tourism Association. Now, in South Africa, the tourism industry lost about 40 million rands in the first 2 days after the ban was announced, and that was what you were listening to. The chief executive of Southern Africa Tourism Services Association, Mr. David Frost, says this will impact negatively on the expectations of the festive period.
The fact of the matter is we've certainly lost the Christmas period, and that's massively devastating. In the first 2 days after the announcement was made, we had cancellations to the value of 940 million rand wiped out. So some people have been able to postpone their holidays, and we're looking forward to 2022. We'll start recouping some of the losses, but it's not just it's not something that switches on and off with a switch. I mean, the tragedy is they switch it off very quickly. This is a decision that the UK took, and that is an immediate effect. But to get the inbound tourism machine up and running again takes some effort. A lot of our business comes through tour operators that are based in the UK, so their whole marketing and sales machine's got to start kicking into action again. Airlines have got to ramp up capacity. So there's a bit of an inertia before this can actually be turned around. So, as I say, welcome, but it has had a major impact on not only South Africa but the region. And the region is estimated, as a result of Omicron, to have lost $159 million into South Africa and the neighbourhood.
Well, that was Mr. David Frost, the CEO, Southern Africa Tourism Services Association. We move over now to Zimbabwe, where the country's electricity grid collapsed yesterday, plunging most parts of the country into a blackout and worsening the already dire supply situation. The Zimbabwe Electricity Supply Authority confirmed the grid collapse in a statement, saying it was caused by refurbishment at the Kariba Dam, which resulted in 3 units being taken out. But we have to bring us up to date on what's going on now, George Musumba, a senior reporter with Star FM Radio in Zimbabwe, joining us now. Hello, George. Good afternoon.
Good afternoon, Nigeria. Thank you very much.
Thank you so much, Zimbabwe. So what's the situation now, the past situation? What's it now?
Well, good news for Zimbabwe, for business, for industry. The Electricity Supply Authority has announced that they've put back the 3 units which had collapsed yesterday. And they've also announced that they will stop the refurbishment until the 5th of January. So the load schedule will be a bit controlled until after January. So that I think for the festive season, the people will have some electricity.
So these days, it seems we're having this issue of load shedding and the power supply in Zimbabwe, one's too many. What's really going on? Is it that there are major rehabilitation or, work going on in the infrastructure, or is it just a norm?
The 2 power units, the major generators, have also been going under refurbishment. There is one which has been under refurbishment. They are also expanding it. So some of the units have been going down. The old ones, these date back to the 1960s. So these have been going down, all the equipment. And then Kariba, which went down yesterday, there's also been some refurbishment. But the power authority also has been facing challenge in getting revenue from customers. People have not been paying their dues, so to speak. So they are owed about 11 billion Zimbabwe dollars. And so they've been trying to recoup this money so that it is recycled, so that they can augment some of the imports with the money that they generate from paying clients. So they've been going out on a drive to get the clients to pay for the electricity that is being used. So it is actually 2 things, the refurbishment of the equipment and also the non-payment of what is due to the power authority that has been causing the power outage. It had stabilized for a while, but I think people got complacent and the authority didn't follow up on the money it was for.
Well, it shows that there's a lot of work to be done in regulating and collection of the fees there. But what is all this doing to the small and medium enterprises? They seem the worst hit, down there at the bottom of the ladder.
Very true. The small to medium enterprises have taken the major blow because they don't have the capacity to install solar to augment their power source. You will notice that the big mining companies, the big industry, they have now diversified into solar farms to supply their electricity. But for the SMEs, they have to wait and endure long load shedding programs, which has meant that the dent on their income, on their revenue, has gone down. Looking from where I'm seated at StarFM right now, you can see some of the shells where the SMEs are supposed to operate. They've shut down the doors because there's no electricity supply then on the SMEs.
All right, thank you so much, George, for bringing us up to date on the power situation in Zimbabwe, and do enjoy the rest of your day. So that's it on the program. Thank you so much for being a part of it. Let's do it again tomorrow. I'm Ini John Mekwa.